What if the difference between staying stuck and building real wealth comes down to just 5 patterns? Patterns observed through crashes, booms, fear, and fortune for nearly 70 years. This new year, we reset the rules and rebuild your financial future from the ground up. Every new year gives you a clean balance sheet, but most people waste it repeating old mistakes. The world changes, markets swing, fear rises, and opportunity hides in plain sight. This message is about patterns that survive time itself. Learn how discipline beats luck, how patience compounds power, and how clear thinking can turn chaos into your greatest advantage. Boom, bust, panic, recovery. This rhythm has repeated itself through every generation, every market, every economy. Technology evolves, companies rise and fall, and headlines change, but human behavior stays remarkably the same. Greed shows up at the top. Fear takes over at the bottom, and confusion fills the space in between. This is why the cycle never truly changes. Most people believe this time is different, yet history quietly proves otherwise. The market is not random chaos. It's a reflection of collective emotion moving in predictable waves. The real separation between winners and losers does not happen during the boom or the crash. It happens long before either arrives. During calm periods, when markets feel boring and nothing dramatic is happening, most people switch off mentally. They spend freely, invest carelessly, and assume stability is permanent. But the disciplined few do the opposite. They prepare. They strengthen their balance sheets, build cash reserves, reduce unnecessary risk, and study past cycles. They understand that calm is not a guarantee. It's a warning sign that conditions will eventually change. When the bust arrives, the unprepared panic. They sell at the worst possible time, not because the math demands it, but because emotion overwhelms logic. Fear convinces them that survival requires immediate action, even when patience would be wiser. Panic spreads fast, and markets exaggerate both optimism and despair. Prices fall not just because value is lost, but because confidence disappears. This is where most damage is done, not by the downturn itself, but by reactionary decisions made under stress. Recovery, however, always follows. It may take time, and it never feels obvious in the moment, but history shows that economies heal, innovation continues, and capital finds new growth. The people who succeed are not the ones who perfectly time every move. They are the ones who anticipated the cycle and positioned themselves before the chaos began. They didn't wait for fear to tell them what to do. They had a plan long before emotions entered the room. To stop reacting is to reclaim control. Reacting means letting headlines, social media, and short-term price movements dictate your decisions. Anticipating means accepting uncertainty as normal and preparing for it in advance. It means asking, what happens if conditions worsen? And am I strong enough to endure volatility? Those questions lead to smarter asset allocation, healthier risk management, and greater confidence when others are losing theirs. Anticipation also builds psychological strength. When you expect cycles, downturns don't shock you. They confirm what you already understood. Instead of fear, you feel clarity. Instead of rushing, you evaluate. This mental edge is often more powerful than capital itself because it allows you to act when opportunity appears disguised as crisis. The market doesn't reward speed, it rewards readiness. Those who prepare during calm don't just survive chaos, they use it. They recognize that cycles are not enemies to be feared, but forces to be respected. Once you truly accept that boom, bust, panic, and recovery are inevitable, you stop fighting reality and start aligning with it. That's when reacting ends, anticipation begins, and long-term wealth becomes possible. Before chasing massive gains, the most important decision you will ever make is to protect what you already have. Capital is not just money. It is time, effort, discipline, and opportunity stored in financial form. Once it's lost, rebuilding it requires far more energy than growing it steadily. This is why true long-term success is not built on bold bets or constant excitement, but on survival. Those who stay in the game long enough are the only ones who ever experience outsized victories. Many people enter investing with the wrong mindset. They focus on how fast they can win instead of how easily they can lose. They chase stories, hype, and short-term returns, believing that one big move will change everything. But history is brutal to this approach. Markets punish overconfidence, leverage, and impatience. A single careless decision can erase years of progress. Avoiding that outcome is not weakness, it is wisdom. Avoiding ruin means understanding risk before thinking about reward. It means asking not, how much can I make, but what could go wrong, and can I survive it? This mindset naturally leads to diversification, position sizing, and patience. It encourages you to spread risk instead of concentrating it blindly. It reminds you that no opportunity is worth betting your future on. When you respect downside risk, you give yourself the ability to recover, adapt, and continue. Survival creates optionality. When you still have capital, you still have choices. You can wait, you can learn, you can act when conditions improve. Those who blow up early lose not just money, but the chance to benefit from future opportunities. The market is generous over long periods, but it is unforgiving to those who cannot endure its storms. Staying solvent is what allows compounding to work its quiet magic. Time is the most underestimated advantage in investing. Compounding doesn't need extraordinary returns, it needs consistency and longevity. A modest, repeatable edge applied over decades can outperform brilliant strategies that collapse under pressure. But time only works for you if you remain in the game. One catastrophic loss ends the process entirely. That's why avoiding ruin is not just a defensive strategy. It's the foundation of every great success story. Protecting capital also builds emotional stability. When you know that a downturn cannot wipe you out, you think more clearly. You are less likely to panic, less tempted to make reckless moves, and more capable of seeing opportunity where others see only fear. This calm mindset becomes a competitive advantage. While others are forced to sell, you are able to evaluate, step in, and act from strength rather than desperation. Big wins come later, not first. They are earned through patience, discipline, and the humility to survive before you thrive. Wealth is not built by trying to be right all the time. It is built by refusing to be permanently wrong. When you protect your capital, you protect your future. Stay in the game, avoid ruin, and let time and discipline do the heavy lifting. The biggest losses don't come from bad math. They come from fear. Numbers rarely destroy portfolios on their own. Emotional decisions do. Fear has a unique ability to hijack logic, shorten time horizons, and convince intelligent people to act against their own long-term interests. In moments of stress, the brain shifts from reasoning to survival mode, and the goal stops being make good decisions and becomes make the pain stop. That is when damage happens. When markets fall, fear amplifies every negative signal. Headlines turn dramatic, social media turns frantic, and uncertainty feels unbearable. Prices drop, and instead of seeing value, people see danger. Logic says volatility is normal. Fear says catastrophe is permanent. Under that pressure, investors sell not because fundamentals changed, but because emotions demand immediate relief. This is why downturns often overshoot reality. Fear doesn't move in straight lines, it accelerates. Fear also disguises itself as caution. People tell themselves they are being safe by exiting positions, sitting on the sidelines, or following the crowd. In truth, they are surrendering control to emotion. Once fear takes the wheel, long-term plans collapse into short-term reactions. Decisions become impulsive, inconsistent, and disconnected from strategy. What was once a thoughtful process turns into a series of defensive moves driven by anxiety. Training yourself to think clearly when others can't is not about eliminating emotion. It's about mastering it. Emotions will always be present. The goal is to prevent them from making decisions for you. This starts with preparation. When you understand that fear is inevitable during uncertainty, it loses some of its power. You stop being surprised by it and start observing it. Awareness creates distance, and distance restores clarity. Clear thinking under pressure is built long before pressure arrives. It comes from having rules, risk limits, and a framework that guides action when emotions rise. When markets fall, disciplined investors don't ask, "How do I feel?" They ask, "What does my plan say?" That simple shift keeps decisions grounded in logic rather than emotion. A plan acts as an anchor when fear tries to pull you off course. Experience also sharpens emotional control. The more cycles you live through, the more you recognize fear as a signal, not a command. You begin to notice that the moments of maximum fear often coincide with maximum opportunity. While others are frozen or fleeing, clear thinkers assess value, measure risk, and act deliberately. They don't rush, but they don't hide either. Mental strength becomes a competitive advantage. In markets, intelligence is common. Emotional discipline is rare. The ability to remain calm when others panic allows you to buy when prices are distorted, hold when volatility is uncomfortable, and sell when optimism becomes irrational. These advantages don't come from superior forecasting, they come from emotional control. In the end, fear is unavoidable, but losses driven by fear are optional. Those who train themselves to think clearly under pressure don't just protect capital, they position themselves for long-term success. When logic stays in control and emotions are managed, decisions improve, confidence grows, and outcomes follow. The best chances never feel safe, because real opportunity rarely announces itself in calm and comfortable moments. It shows up disguised as uncertainty, fear, and doubt. When conditions feel stable, prices already reflect optimism. When everything feels obvious, the reward has usually been priced in. True value emerges when confidence collapses, when headlines scream disaster, and when most people are desperate to escape rather than engage. History makes this pattern clear. Every major opportunity was born during a moment of widespread fear: financial crises, recessions, market crashes, geopolitical shocks. In real time, these moments never feel like opportunities. They feel like threats. The language of the media becomes extreme, forecasts turn bleak, and the future seems unpredictable. That emotional intensity pushes prices far below intrinsic value, not because assets suddenly became worthless, but because fear demanded an immediate exit. Safety is emotionally appealing but financially expensive. When something feels safe, it usually means consensus agrees on its value. Everyone wants it, and everyone is already positioned for it. That is not where outsized returns come from. The market rewards those willing to endure discomfort in exchange for future gain. Discomfort is the price of admission for meaningful opportunity. Patience is what separates those who benefit from chaos and those who are crushed by it. Patient investors do not rush to act at the first sign of trouble, nor do they panic at falling prices. They wait, observe, and let fear exhaust itself. They understand that panic creates distortions, and distortions create value. While others focus on what could go wrong tomorrow, patient thinkers evaluate what is likely to recover over time. Preparation turns fear into fuel. When you are financially strong, emotionally disciplined, and strategically ready, fear becomes less threatening. Cash reserves, manageable risk, and a clear plan allow you to step forward when others step back. Prepared investors don't need certainty, they need probability. They don't require perfect clarity, they need reasonable confidence that the world is not ending, even if it feels like it is. Headlines are designed to provoke reaction, not reflection. They amplify worst-case scenarios because fear captures attention. But markets move ahead of news, not behind it. By the time disaster is universally acknowledged, much of the damage is already reflected in prices. Those who wait for reassurance often miss the window where value is most attractive. Opportunity does not wait for comfort. It fades as fear subsides. Acting during moments of fear does not mean being reckless. It means being selective, rational, and disciplined. It means understanding that uncertainty is not the same as permanent loss. Strong businesses, productive assets, and resilient systems do not disappear because of temporary shocks. Over time, they adapt, recover, and grow. Investors who recognize this can separate short-term noise from long-term reality. The prepared mind sees what fear hides. When others see only risk, it sees imbalance. When others see chaos, it sees mispricing. This perspective is not instinctive. It is trained through experience, study, and discipline. The reward for that effort is the ability to act when opportunity is greatest and competition is lowest. In the end, the best chances will always feel uncomfortable. That discomfort is not a warning sign. It is the signal. When headlines scream disaster and confidence vanishes, value is often being quietly handed to those willing to remain patient, prepared, and clear-headed while others look away. Cash isn't laziness, it's flexibility. Many people view holding cash as doing nothing, as if not being fully invested is a sign of weakness or indecision. In reality, cash is one of the most powerful tools an investor can possess. It represents optionality, control, and the ability to act decisively when opportunities arise. While others scramble in fear or panic, having liquidity allows you to make moves others cannot. It is freedom packaged in a tangible form, ready to be deployed strategically when the moment demands. Cash gives power when prices fall. Markets are volatile by nature and downturns are inevitable. When asset prices drop sharply, those with liquid resources can act while others are paralyzed by uncertainty. They can purchase high-quality investments at a discount, entering positions that may have been inaccessible during times of market euphoria. In contrast, those fully invested often have to sell at depressed prices just to meet obligations, locking in losses and forfeiting the potential for future gains. Holding cash turns fear in the market into opportunity for the prepared, allowing you to take advantage of dislocations rather than being victimized by them. Liquidity also provides confidence. When the world around you seems unstable, knowing you have cash to fall back on reduces stress and prevents panic-driven decisions. Emotional control is one of the greatest advantages an investor can have, and cash is a direct contributor to that control. It removes the pressure of forced action, giving you the ability to think strategically rather than react impulsively. Confidence in your capacity to act with precision under pressure often leads to outcomes far superior to those who are forced to chase trends or exit at inopportune times. Flexibility is another critical aspect of holding cash. Markets change, circumstances evolve, and new opportunities emerge constantly. When you have liquid resources, you are not tied to a single strategy, position, or narrative. You can pivot quickly, adjust allocations, and respond to new information without hesitation. Flexibility allows you to exploit inefficiencies, hedge risks, and capture returns in ways that a fully committed, inflexible portfolio cannot. It transforms you from a passive participant into an active, opportunistic player capable of shaping outcomes rather than being shaped by them. Moreover, cash allows you to take calculated risk with clarity. Risk is only meaningful when you have the capacity to absorb it. Cash creates a buffer that enables smarter decisions and mitigates the consequences of error. Instead of gambling or over-leveraging, you can deploy resources where the probability of success is high with a plan for every scenario. This mindset not only preserves capital, but enhances the potential for compounding gains over time. Holding cash is not a sign of hesitation. It is a strategic advantage. It creates freedom, reduces emotional stress, and provides the flexibility to seize opportunities others cannot. Those who understand the power of liquidity are never forced into reactive decisions by market chaos. Instead, they remain calm, confident, and ready, using their resources to turn volatility into opportunity and uncertainty into wealth. Cash is not idle. It is the foundation of resilience, discipline, and long-term success. Doing more doesn't mean earning more. Many people confuse business with productivity, activity with effectiveness, and effort with results. In investing, business, or wealth building, quantity rarely substitutes for quality. Moving constantly, chasing every trend, and reacting to every signal creates noise, drains energy, and often leads to mistakes. True success comes from focus, precision, and the ability to concentrate on the decisions that matter most. It is not how many actions you take, but how good each action is that determines outcomes over the long term. High-quality decisions are built on preparation, knowledge, and clarity. They require you to understand the variables, anticipate outcomes, and weigh risk against reward. Those who scatter their attention across too many opportunities fail to develop the insight and discipline necessary for excellence. By contrast, concentrating on fewer, carefully selected choices allows you to devote the time, analysis, and focus necessary to make each one count. One thoughtful, well-executed decision can produce far greater results than 100 rushed attempts. When you act with clarity and size, not hesitation. Indecision or half measures is the enemy of success. Hesitation leads to missed opportunities, diluted results, and second guessing. The market, or any competitive arena, rewards conviction. Acting decisively does not mean acting recklessly. It means having the confidence and preparation to deploy capital resources or effort in proportion to the opportunity. Those who act with clarity know their rationale, understand the risks, and position themselves to capitalize fully on the potential upside. Size matters because meaningful results require meaningful commitment. Acting decisively also reinforces discipline. Every action should align with a broader strategy and long-term goals. Random activity may feel productive, but it rarely moves the needle. Focused action ensures that your time, energy, and resources contribute directly to outcomes that compound over time. This is particularly true in markets where patience and clarity amplify returns and noise often destroys them. By concentrating on high-quality decisions, you reduce errors, minimize wasted effort, and position yourself to take advantage of moments of opportunity when they arise. Fewer, better actions also reduce emotional strain. Constant activity increases stress, creates confusion, and makes it harder to learn from mistakes. When you limit yourself to carefully considered decisions, you can evaluate each result, refine your approach, and improve over time. The clarity gained through focus allows you to respond to challenges with reason rather than reaction, to recognize opportunity when it appears, and to act decisively without hesitation. In essence, effectiveness is not about doing everything, it's about doing the right things. High-quality decisions taken with clarity and executed fully produce far more wealth, progress, and advantage than endless activity without purpose. Those who master focus, patience, and decisive action rise above the noise, achieving results that far exceed the effort they appear to expend. Doing less, but doing it better, is the foundation of lasting success. Compounding doesn't need genius, just consistency. Too often, people assume that extraordinary wealth or exceptional results require extraordinary intelligence, secret formulas, or brilliant timing. In reality, compounding is far simpler, yet far more powerful than most realize. It works quietly, invisibly, and relentlessly, rewarding those who show discipline over decades rather than those who chase quick wins. The secret is not in making perfect decisions every time, but in making small, smart choices consistently and letting time magnify their impact. Every day, most people underestimate the power of incremental gains. A slight improvement in spending habits, a marginal increase in savings, or a slightly smarter investment decision may seem insignificant in the short term. 1% here, 2% there, it feels trivial. But when these small edges are repeated month after month, year after year, the results grow exponentially. This is the essence of compounding. A tiny advantage applied consistently becomes enormous over time. The effect is almost magical, yet it requires no special insight beyond patience and discipline. Consistency is the real genius of compounding. It is easy to start something new with enthusiasm, but far harder to maintain it when distractions, temptations, or setbacks arise. Many people abandon good habits too soon because they expect immediate results or become discouraged by temporary losses. Compounding punishes impatience and rewards persistence. The earlier you start, the more time your decisions have to grow, and the more powerful the final outcome becomes. Those who embrace consistency, even with modest gains, often achieve results that appear unattainable to those seeking dramatic shortcuts. Small, smart decisions are the building blocks of compounding. It is not about chasing the next big investment or predicting the future with perfect accuracy. It is about making choices that have a positive expected value, managing risk, and repeating them relentlessly, saving a portion of income, reinvesting returns, learning continuously, and avoiding destructive habits. These are all small actions that accumulate into life-changing results. Over time, compounding does the heavy lifting, transforming modest beginnings into substantial wealth, stability, and freedom. Another often overlooked aspect of compounding is its psychological effect. As results grow, confidence increases, patience deepens, and discipline strengthens. Each success, no matter how small, reinforces the habit of making good choices, creating a virtuous cycle. The key is to avoid shortcuts that promise speed but threaten consistency. Quick wins are fleeting, steady progress is permanent. Compounding also extends beyond finance. Knowledge, skills, relationships, and reputation all grow in a similar way. Small, consistent investments in yourself and your network accumulate over years, producing outcomes that appear extraordinary in hindsight. The pattern is always the same: consistency multiplies effort, time magnifies results, and persistence outperforms brilliance when brilliance is fleeting. Ultimately, compounding is about patience, discipline, and faith in incremental progress. It doesn't require genius, luck, or perfect timing. Only the willingness to make small, smart decisions repeatedly and trust that time will do the rest. Those who embrace this principle discover that outcomes once thought impossible are entirely achievable, and that the quiet power of consistency can transform their financial life, their career, and their future. Opinions are loud, facts are quiet. Everywhere you look, there is noise, people shouting their predictions, social media amplifying panic or hype, and headlines designed to grab attention rather than convey truth. Most investors, entrepreneurs, and decision makers react to this noise, allowing the opinions of others to shape their choices. They chase trends, follow the crowd, and measure success by the applause or attention they receive. But noise is fleeting, it moves fast, changes constantly, and rarely reflects underlying reality. Facts, on the other hand, are stable, measurable, and often invisible. They don't demand attention, but they dictate outcomes. Understanding the difference is the key to lasting success. Winners learn to block distractions and tune out the noise. They recognize that opinions are often motivated by fear, greed, or a desire for visibility, not by insight. When everyone else is reacting emotionally, they pause, analyze, and focus on what truly matters. They don't get caught up in short-term fluctuations or social pressures. Instead, they concentrate on fundamentals, data, and principles that persist over time. This ability to stay centered allows them to make decisions with clarity and confidence, even when the world around them is chaotic. Focusing on what truly moves value requires discipline. It means looking beyond headlines and hype to the underlying forces that determine long-term outcomes. In investing, this could be understanding the financial health of a business, the trajectory of an industry, or the sustainability of cash flows. In business, it means prioritizing activities that generate measurable results rather than chasing trends that offer temporary excitement. By concentrating on fundamentals, winners ensure that their actions are aligned with reality rather than perception. Short-term trends are seductive because they are easy to see and tempting to follow. Social media news cycles and market chatter make it feel urgent to react to every new piece of information. But reacting to every trend creates fatigue, mistakes, and misallocation of resources. True value is rarely captured in a day, a week, or even a month. It emerges over time quietly as a result of sound decisions applied consistently. Those who chase trends are often left behind when the noise fades, while those who focus on enduring truths reap the benefits. The quiet power of facts also builds confidence. When your decisions are grounded in reality rather than emotion or opinion, you can act decisively. You don't second guess yourself based on the latest tweet or headline. Instead, you trust your analysis, your preparation, and your understanding of the forces that drive value. This confidence allows you to take advantage of opportunities that others miss because they are distracted by noise and uncertainty. Over time, the ability to distinguish between loud opinions and quiet facts becomes a compounding advantage. Each disciplined decision, each ignored distraction, and each focus on fundamentals strengthens judgment and builds resilience. Winners don't need to be the loudest or the most visible. They simply need to understand what truly matters, act accordingly, and let results speak for themselves. By learning to block distractions and concentrate on lasting value, they consistently outperform those who are swayed by the fleeting clamor of opinions. What worked yesterday may fail tomorrow. Markets, economies, and industries are constantly evolving, and strategies that once seemed foolproof can become obsolete overnight. Relying solely on past success is a trap that many investors fall into, believing that yesterday's formula guarantees tomorrow's results. The truth is that the world is dynamic, and rigid thinking is a liability. Conditions change, new information emerges, and unexpected events can render previous approaches ineffective. Those who cling to old methods without adapting are often blindsided when the environment shifts. The strongest investors understand this reality and embrace evolution as a core principle. They study outcomes, assess mistakes, and recognize patterns not just to repeat what worked, but to anticipate what might work next. Learning becomes a continuous process rather than a milestone to be achieved once. They read, analyze, and observe with the mindset that knowledge is never complete. Each experience, whether a win or a loss, is an opportunity to refine their approach, sharpen judgment, and strengthen resilience. This adaptive mindset ensures they remain competitive even as circumstances change. Adjusting without ego is critical. Pride, stubbornness, and the need to be right can cloud judgment and prevent necessary changes. Many investors hold on to failing strategies because admitting error feels like weakness. But the strongest recognize that survival and growth require humility. Flexibility is strength precisely because it allows one to pivot without hesitation, discard outdated assumptions, and embrace new opportunities. Ego is a barrier, adaptability is an advantage. The ability to change course when warranted separates those who endure from those who falter. Flexibility is not just about reacting to change, it's about anticipating it. The best investors are constantly scanning for signs that their assumptions may no longer hold. They diversify strategies, monitor trends, and prepare for multiple scenarios. This proactive approach allows them to adjust quickly and decisively rather than being forced into reactive decisions by circumstances. They don't cling to the familiar out of comfort. They embrace the unknown with preparation and awareness. Being flexible also cultivates resilience. Change often brings uncertainty, volatility, and risk. Those unwilling to adapt may face catastrophic losses, but flexible thinkers absorb shocks, reassess, and continue forward. Flexibility transforms disruption from a threat into an opportunity. While others panic when their old methods fail, the adaptive investor sees new possibilities, adjusts allocations, or explores alternative strategies that better suit the new reality. In essence, strength comes from movement, not rigidity. It comes from recognizing that success is temporary and that learning, adaptation, and humility are ongoing requirements. The world will always shift, and the strategies of yesterday may not fit the challenges of tomorrow. By evolving continuously, learning from experience, and adjusting without ego, investors maintain an edge that rigid adherence to past successes cannot provide. Flexibility is not a compromise, it is the foundation of enduring success, allowing individuals to navigate uncertainty capitalize on new opportunities, and thrive in an ever-changing landscape. This isn't just about money, it's about mindset. Wealth is not solely a measure of the dollars in your bank account or the assets you accumulate. It is a reflection of how you think, how you approach challenges, and how you make decisions over time. Without the right mindset, even the best strategies, the most brilliant insights, or the largest capital can be wasted. Your mental framework determines how you respond to opportunity, adversity, and uncertainty. It shapes your habits, guides your discipline, and ultimately decides whether you thrive or merely survive. Decide today to think long-term. Many people fall into the trap of short-term thinking because it feels urgent and tangible. The immediate gain is seductive, while long-term benefits seem abstract or distant. But real success, financial, professional, or personal, is built by consistently making decisions that favor the horizon over the instant. Long-term thinking requires patience, foresight, and a willingness to delay gratification. It means prioritizing investments, habits, and actions that may not pay off today or tomorrow, but compound powerfully over years and decades. Each small, rational choice becomes a building block, and over time, these blocks form an unshakable foundation. Acting rationally is equally critical. Emotions are a constant presence, and the pressure of markets, peers, or circumstance can easily cloud judgment. Fear, greed, and ego push people toward impulsive decisions that seem logical in the heat of the moment, but are destructive in the long run. A rational mindset allows you to step back, evaluate situations objectively, and make choices based on facts and principles rather than fleeting emotions. It is the difference between reacting to volatility and responding strategically, between being swayed by noise and staying aligned with your plan. Rationality creates consistency, and consistency produces compounding results over time. Playing to win, not just to survive, is the mindset that separates achievers from participants. Surviving is about maintaining status quo, avoiding mistakes, and simply weathering challenges. Playing to win, on the other hand, requires ambition, courage, and calculated risk. It is about positioning yourself to seize opportunities when they arise, about being proactive rather than reactive. Those who adopt a winning mindset understand that failure is not fatal. It is a lesson, a stepping stone, and a necessary part of growth. They are willing to think differently, challenge conventional wisdom, and act decisively when the moment calls for it. This mindset transcends money. It affects how you manage time, relationships, knowledge, and energy. It encourages disciplined habits, continuous learning, and the resilience to overcome setbacks. It empowers you to see beyond immediate discomfort, embrace calculated risks, and capitalize on opportunities that others overlook. Thinking long-term, acting rationally, and playing to win become interconnected pillars that reinforce each other, creating a framework for sustained success and personal growth. Ultimately, the foundation of wealth is mental. Resources, assets, and strategies are important, but without the mindset to deploy them wisely, they cannot achieve their potential. Decide today to cultivate a mindset that values patience over impulse, clarity over noise, and ambition over mere survival. By mastering your mind first, every other aspect of wealth, financial, professional, and personal, becomes attainable. This is where true power lies, not in luck, connections, or timing, but in the deliberate control of how you think. Choose and act every single day this year. Don't chase hype, build discipline, respect risk, trust patience, because wealth doesn't come to the loud. It comes to the prepared.